Question 46. This question asking for the amount of money that each class of creditors can anticipate receiving. Well, similar to prior questions, we can prepare the statement of financial affairs and determine that percentage about how much they can receive. Okay, and also for those assets, when we prepare the statement of financial affairs, always use their net reliable value, no longer their book value. Okay, so first, when we prepare the statement of financial affairs, we start with assets, and an asset first is the pledged with fully secured creditors. In prior questions, looks like all those assets cannot be fully paid for the liabilities. So we start with a pledge with partially secured, but in this question, they do have some assets that can fully cover the liabilities. Okay, so first, based on information we are given, we know there is notes payable is secured. So notes payable amount is 65,000, is secured by a land with a net reliable value of 72,000, which means that there is 7,000 available for the unsecured creditors. The 7,000 equal to the land's net reliable value 72,000 and minus notes payables amount 65,000 equal to 7,000. Okay, so then let's move on to those asset pledged with partially secured creditors. First is the building, and so the building's amount is that reliable value is 68, and it's used to cover the notes, another notes payable, and the amount is 78,000, which means that that's not enough. That's why it's called partially secured creditors, and nothing available for unsecured creditors for those buildings. Second one is there's a bonds payable, 115,000. Is secured by equipment with a net reliable value of 35,000, which means that nothing available for unsecured creditor left. Okay, so then let's move on to those free assets are not pledged with any other secured creditors. So they have cash, accounts receivables, inventory, supplies, and investment, and all the amount here that's available for unsecured creditors based on its net reliable value. Okay, so the total available to pay liabilities with priority and unsecured creditors is 70,000. Include all the numbers we have prepared so far over in this column. All right, so we have to stop here when we prepare statement because we don't know anything about those liabilities with priority or total liability to those unsecured creditors amount would be before we prepare the liabilities part. Okay, so let's move on to the liabilities part. First is the liabilities with priority. That's the one we are looking for right now. The liability with priority including the administrative expense, salary payables, and income tax payables. In total, that's 38,000. Sorry. Okay, so okay, that's the amount we input here, 38,000. And after we use the total available to pay liabilities with priority and unsecured creditors, then the amount that's left is 32,000 available to pay for other unsecured creditors. And for okay, so next let's see how much they owe in total to those unsecured creditors. First, we have fully secured creditors. There's the notes payable, 65,000. It's covered by a land. Value is 72,000, which means that everything has been paid, nothing left. And for those partially secured creditors, there's notes payable. It's covered by a building. Still, it's only covered 68,000. Still have 10,000 unsecured. And for the bonds payable, the total amount is 115,000. It's covered secured by equipment, but only have 35,000 net reliable value, which means that 80,000 is unsecured. And the last one is for those completely unsecured creditors, those accounts payables. In total, 70,000. So the total unsecured and non-priority liabilities are here, and the total amount is 160,000, and this is the amount we need over here. So this is the total amount that's the company need to pay, but the company only have 32,000 available, which means that there is 126,000 deficiency. So there's important percentage we need to calculate is that we use the total available funds 32,000 for the unsecured creditors divided by the total amount the owed the unsecured creditor, that is 0.2, which means 20%. So which means that for those unsecured part, each creditor only get 20% of that amount back. So for example, here, let's look at those creditors. So for the fully secured creditors, they can get everything back. So there's no question. So for example, for this note payable of 65,000, because it's fully covered by the land, then they get everything back. For this another notes payable, in total, the company owed them 78, but they can only get 68 back first, and then plus 20% of this 10,000, which means that it should equal to 2,000, should equal to 70,000. So that total amount they can get. Well, for the bonds payable, it can get 35,000 of the equipment net reliable value, and then plus 20% of this unsecured part. Well, for accounts payable, that 20% of the 70,000. So this is equal to 14,000, right? 14,000. So this should equal to 41,000. Oh, 51, maybe 50.